Good morning, everybody. Hope everybody's doing well. Good morning. Good morning. Good morning, Butch. 6680. We got to hit 6,700 first. We'll talk about that. Large, significant level on the SPXA. So actually, I'm watching 6750. That's key strike for this morning. So, yeah. So we'll see how we act or react around there. So, and the spike in the VIX, obviously, we're hitting area, usually extreme. So on the VIX, unless we're going to go to 40 or 50, but usually this is an area where you might see VIX back off. So as in the previous couple days. So we'll see. We'll see. I don't even, what's the VIX hitting this morning? Let me see. The VIX, where are we at pre-market? 901. So we're hitting 27, 28. Yeah. So yeah, historically, if you scroll back, this is right in that area where we could see a reversal. We actually see COI up there at 35 on the VIX. So drunken. Yeah. Drunken is very drunken. That's true. Yep. So I historically watch the VIX around this level, 27, 28, 29, where we could see a reversal, unless we're going to have some significant event. Obviously, you see that all the way back in October. We ran up there, obviously, and then previous areas, but yeah. So for me, if we get above this, but we'll just see. Okay. Thanks everybody for joining us. Let's go ahead and get right into it. This is Michael coming to you from Game Edge on Friday, March 6th, TGIF, obviously. Thanks for joining us. Again, gameedge.com, is our new website. Make sure you check that out. Like and subscribe on X and YouTube. You'll be notified when we go live. So let's go ahead and jump right into it with our three pillars here at Game Edge that we cover: sentiment, structure, and trend. Obviously, starting with the market trend model. That's the core pillar. And if we want to be on the right side of the market, we'll watch the market trend model. The key takeaway is this is based on the tick index, buying versus selling. The bolded white line is your intraday instantaneous cumulative tick. And yesterday was the first day that we actually saw some significant weakness intraday, moving below those short-term railroad tracker momentum moving averages. So again, this was cautionary throughout the day. And then once we closed below these shorter-term moving averages, if you had long capital at risk or at work, it would have been a good idea to reduce that risk heading into the day. And then obviously we're seeing this morning the gap down for today. Again, draw your attention up here, new highs versus new lows. New highs were not outpacing new lows. It's been fairly flat for 2 days. And then our filtered cumulative tick indicator obviously went below zero yesterday. This is plus 1,000, minus 1,000 larger block orders, as well as institutions, and closed significantly lower. So again, this was your risk off day, closing below these short-term momentum moving averages. The intraday instantaneous CT, and then the railroad track is your 1 to 3 day time period for swing trades. So closing below that should have been your flag or gate to take off risk heading into the close. And then obviously gap down today. If you're a longer term market trend follower or speculator, again, this colored ribbon is the gate for that. Our mechanical portfolios are still turned on. The red is above the cyan and expanding to the upside. So is this just a pullback within a longer term uptrend? Or are we going to see some sort of longer term pullback in the overall market or larger pullback? We'll have to watch this bolded white line to see if it fails at these momentum moving averages and turns back to the downside and starts cutting through the colored ribbon. Then that would turn all of our mechanical portfolios off. And then we'd be looking to reduce our risk significantly, possibly for a larger market pullback. The market trend model yesterday for our trading view, again, indicating right at the open, we were seeing some weakness here. You can see that was actually red. The background is kind of greenish black, but this is indicating it's not significantly buying or significant buying in the overall market. So again, that's cautionary. And then we started moving below those shorter term momentum moving averages very quickly, and background turned red. Obviously significant selling coming into the market. So if you were thinking long, that was your thesis, then you should have been flipping that thesis, or at least closing all your long positions if you're a 0DT trader, and then looking to get short at key levels as we cross below those key levels in the overall market. Then we did see a slight rebound towards the end of the day, but again, closing below those shorter term momentum moving averages, railroad tracks, again, indicating significant weakness in the market. And now you're walking into a gap down today. So hopefully this picture helps you day over day to understand how you should be positioning from a 1 to 3 day time frame or an intraday 0DT time frame. Obviously, significant risk off yesterday and closing below these previous close, as well as we have some tag combos that indicate this was bearish close also. Below these momentum moving averages, you should have been reducing risk into the close. All right, let's move on. The SPX, largest, most notional value options complex. We separate the SPXA from the SPXP. SPXA is your cruise ships or your tankers. Again, this steers overall price on a longer term time frame. So this is our 4-month path of continuity. So this is just basically indicating the next 4 months how the structure is positioned. Again, we're put dominated in that structure. Below 68.60, we'd be more risk off for a pullback in the overall market. And then our implied open is roughly around 67.50 this morning. Again, on the SPXA, you can see that's a small blip of supportive action via charm and net delta because of the out of the money puts there. And then as well as the call OI there, again, in the money calls here, out of the money puts here, again, in the money calls. If you're above that level, again, those will continue to be supportive. And then below that, we'll move on down to the put dominated strike at 67.25 and then 6700. Again, if you're above those, these are out of the money puts. So again, if you're above that level, the charm should continue to grow on those and should be supportive. Again, agree, George, 6700 is a very key level for the SPXA and the overall market. If we get below 6700, again, we're looking for more risk off for a move, down towards some other strikes that we're looking below. So really that's the line in the sand for us on institutional positioning as well as the overall market. So we'll continue to watch that if we test that today. All right, moving on to the SPXA Greeks. Again, net summary here, highest sensitivity levels. I don't normally show this, but again, just wanted to show the key sensitivity levels to the downside. Obviously, see from a charm, gamma, and Vanna standpoint, 6,700. If we lose 6,700, these out of the money puts will become a headwind, and that will increase the move to the downside there. And then to the upside, you see the Vanna is actually very well primed for a move back to the upside. If we see a drop in volatility and out of the money calls come in, we're almost 4-to-1 on the out of the money calls on the Vanna side. So the spring is continuing to get coiled. If we see a drop in volatility and out of the money calls come in, this could cause a quick spike back to the upside. So just be understanding of that on that Vanna side. And then charm, obviously 6,700, those are out of the money puts. Again, if we're above that, those should be supported. But you see the out of the money calls obviously are winning the overall battle. So we call this a locked horns condition. So upside appreciation will be difficult until we change this overall picture to call dominated. So we'll continue to watch that on the SPXA. And this is into the March monthly expiry. So if we hold 6,700, we'd anticipate that we'd be stuck within this range into the monthly OPEX March unless we go below 6,700. All right, moving on to the SPXP net stat command, SPXP web app. Again, upper quartile chosen here. Put dominated as you would anticipate. GEX and DEX transition slightly misaligned there, but the bottom overall is in the 68.45, 68.50. So if we head back up towards this level, we're watching for the first failure retest of that area. 6,800, obviously overhead will be a large headwind, net charm there at that level. And then 67.70, 67.50, and then you obviously see 6,700 down here. That's key strikes. Again, if we start traversing back to the upside, we'll have to watch these areas for a headwind as we move up for failure or rejection into those overhead areas. If we do capture 6,800, we think we could have a quicker move back up towards the bottom of those transition areas. Bottom of DS is 68.25 today. And then we have a confluence of a GEX and DEX transition around 68.45. So we'll watch that if we see a drop in volatility and how the money calls come in. Okay, SPXP GEX ratio. Again, I spoke about this yesterday, that we're actually seeing a negative slope as the SPXP moved up. So again, that was a negative divergence. Negative divergence in the overall structure. Again, we were not seeing the out of the money call speculation come in. Out of the money puts or shorter dated put gamma was actually increasing, dropping this GEX ratio to the downside. So was not being supportive of SPXP moves to the upside. All right. 0.6 level heading into today. Obviously, we're reaching another extreme as we've saw before. 0.54, we saw the bounce. Now we're heading into today at 0.6. Again, this may not be the day that we see an overall long tail to the downside and a bounce, but we'll continue to watch this. But historically, when we reach these extremes, we do see a bounce. Now, this could stay pegged to the downside for a significant amount of time if we're entering a larger bear market or a larger pullback. But we'll just continue to watch this to see if this is a profit-taking or monetization move to the downside around 6,700 to 6,750, and if we see a bounce back to the upside on the SPX. All right, moving on to Delta Bounce. Key takeaway here is this is separating the overall structure, right-hand plane from left-hand plane, above spot price, below spot price, and what market participants were doing. The green dotted line obviously is the right-hand plane. That's out of the money calls to the upside as well as in the money puts. We are pegged at -1 to the downside with a negative slope as well as the Delta Bounce. So again, hardly any call speculation to the upside at all in the overall structure heading into today. And then again, the left-hand plane, we actually see some in the money calls still, but negative slope here, and we're just hovering above the zero line. So this easily could drop below zero. And then you see the further on expiry out in time. This is our projected structure of market participants. We're pegged at -1. Everything is below zero, so significantly bearish into next week. So we'll continue to watch that day over day. But again, significant weakness maybe into next week as we don't see any improvement as we were seeing before. This is also spot price sensitive though. So if we do see a bounce today, recover 6,750, 6,800, this can change the overall picture as this is including significant amount of out of the money puts to the downside. So we'll continue to watch that day over day. All right, SPXP net stat command for today, high sensitivity levels, 6,750. It looks like we're already below that level. We're already below that level there. So again, this will be a headwind overhead as these out of the money puts, you're below those. This will be a charm headwind as we try to head back to the upside. And then you see in the money calls all the way down at 6,000. Again, significant strike below us. This is just saying we do have in the money calls below us, but the in the money puts overhead are dominating the whole structure as you saw on the Delta Bounce. And then the key takeaway here, I'll rerun this spot price and I'll show the net stat command here after a little bit if I can get it to populate real quick before we're done. But again, key areas overhead as we bounce to the upside is going to be 6,750. All right, heading into today's 0DT structure, put dominated. Obviously, we're well below any of the structure that we're looking at. So 6,750, you can see that's that key strike. 6,725 is the bottom of our expected move. As defined here, 1.51%, 103 points. Obviously, with the VIX spike, we'll be watching 6,725 and then obviously 6,700 to the downside. If we lose 6,700, we believe that the market really is going to have a significant structural change and we could have a larger pullback in the overall market. That's kind of what I said on some X spaces yesterday that I joined and really discussing that from an SPXA, SPXP whole structure, institutional standpoint, 6,700 will be a key level. So George, 6,700 must be short-term profit-taking area for big fishes. We'll see. Again, remember the SPXA is not significantly traded, right? It's basically a month. It's a monthly expiry. So they're not moving significant amount of money day over day. They'll use the SPXP for shorter dated trades. So those SPXAs are very well entrenched. Usually those go to expiry and they're already hedged, but really is going to be a key level though for the overall market. I believe on a psychological level as well as a structural level. So we'll continue to watch that. And if we see a spike in VIX as we move through the 6,700, I won't talk about skew here, but we're set up to where that could accentuate a downside move if we move through 6,700. That would accentuate a downside move, but also skew is set up to accentuate a rebound and upside move. And then that's when we bring in the Vanna. You saw that was 4-to-1 Vanna tailwind that if we see a drop in volatility and some out of the money calls come in, we could have a significant retrace. And that's when you get a V-shaped rally and everybody's losing their minds because they don't know why it happened. But clearly we can understand why it happened within those, within the SPX Greeks that we're just looking at. So, all right. Thanks everybody for joining us. Again, GameEdge.com, resources, free courses, newsletter, blog. Make sure you check all those out as well as our products and pricing. Join and you'll be delivered some content on the weekend for free. And then our GameEdge Fast Pass. This is our flagship options course. Make sure you check that out. Again, covers all of our thesis, our tools, our methodology. You can look at it before you even join our Discord. So you'll have a leg up before you come in. So, all right, let's take a look at some individual equities. I see some people posting BKNG, booking.com. Awesome. Thanks, George, for joining us. Appreciate the commentary too. And I'm happy to interact with anybody on here. If you guys want to post in the chat, I'm watching it live on X and YouTube. So if you have questions, comments, throw it out there, and I'll be happy to answer if I can. Okay, BKND, put dominated, low OI though. Make sure you take that into account. Hold on one second, everybody. I got it. Okay, sorry about that, everybody. Let's start again. Put dominated on BKNG for Friday's expiry. You're within the overall transition. Supportive at 4,500, 4,600. Key takeaway is the total OI is very low. So looking at the overall hedging metrics and dealer hedging and structure of understanding tail wagging the dog, I would not put a lot of faith in BKNG because of the low OI. So hopefully that helps you on there. What was the next one? Costco. Oh my gosh, what's Costco? The CS. Gosh, what is Costco? CSC. Is it CO? No. Sorry. I can't remember what Costco ticker is. Put it in there. I don't look at Costco that much. Sorry about that. AMD. Put in the Costco ticker and I'll pull it up. Oh, COST. Sorry, that's it. I just remember. Yeah. I just remembered it. Okay, Friday expiry. Put dominated on Costco. You're below transition, so significant overhead headwind there. 955 looks like a pullback level. Supportive charm though here because of these out of the money puts. So you see that. So I would watch those levels there at 987.50 overhead. Let's look at upper quartile. Put dominated, upper quartile. You're below transition. Significant overhead from these in the money puts. You see this here, net delta charm, going to be difficult to move up on Costco, even though we have PGX and COI, or sorry, yeah, PGX up towards 1,000. So not one that I would jump in right away. UCO, we don't pull OI data for that. So bank again that margin. What's the gamma flip level? We don't subscribe to the gamma flip level FT trading. We look at transition areas. So we not necessarily flip. Okay. Yeah, right. Exactly. So for us, that's the transition area, and we're looking on the. This is all from the trader's perspective. So obviously the dealers are on the other side of the trade. So for us, it's a transition level where we transition from a more put dominated overall structure to a more call dominated or favorable structure for a move to the upside. Put dominated structure moves are accentuated, and we look to short the moves to the upside. So short the rips, if you want to say that, in that regime. And then if you're in a more call dominated structure or positive headwind or positive tailwind on pullbacks, we look to buy the dips and sell the rips. I hate that nomenclature though, because that really puts a bias on the overall market. I don't like that. I like to look for supportive type action into key levels if we're in a call dominated structure or above transition. That's why our if thens are so succinct. And if we have a narrow transition area, it gives us good if then tradings. Below it, we look to short moves up, and for above it, we look to buy pullbacks. So yes, agree, George. Yeah, and how you put it was fine. That it's just the industry. They use flips, they use walls, and that's not necessarily true because it's not a call wall, because we can easily overcome that call wall if we have out of the money call speculation intraday from market participants. Same thing as a put wall. You can easily overcome that. And as you move up and down the structure, the Greeks are always changing, right? And obviously gamma peaks where we are at the highest point in the money or at the money or at spot price, right? At that key level. So I hate to use the word wall because everybody uses the word wall as like, oh, we can't get over it. Well, that's not necessarily true. We can move through those levels. It just, you have to have other supporting factors. Obviously, you see Vanna, if we see volatility drop and out of the money calls come in, we could blow through any of those walls to the upside very quickly, right? So yeah. So I hope that helps everybody. I missed Google. Oh, sorry about that. Oh, whoops, that's not our app. Sorry. Google, let me go for that. Sorry about that. Sorry, Google. Put dominated. Now spot prices below transition. So heading into today, I say Friday, that's today. Long week, 302.50 the upside. Not much appreciation, but supportive here as you see those out of the money puts and charm there. So I would not expect, I don't know where Google's trading at pre-market, but 290 would be an important level. And then upper quartile, it's interesting on the upper quartile. So this is a key takeaway here on the web app. You'll notice that these are not included on the upper quartile. March expiry is the next upper quartile that's important. So call dominated, supportive on any pullbacks. In the money calls below us, 280, 265 to the downside. So, all right, sorry, hold on one second. Sorry about that. Insurance stuff. Somebody's trying to file a fraudulent insurance claim on my stuff. So, okay, sell H. Okay, let's see. Friday's expiry. Okay, the other thing is this is a low OI is obviously significant to Friday, so we're just going to take the upper quartile past Friday on Celsius. Call dominated, above below spot price. 40 to the downside looks pretty supportive. Wide transition area though, 60 to the upside. So you just see really non-existent OI within this whole range, except for a few spatterings of larger OI. So make sure you take that into account if you're looking at the overall structure here. But we're still call dominated. Obviously, a significant portion of the calls here are at the 40 level and the 60 level. So it's a very wide range. And that's showing on the transition area. As compared to the SPX, it's very narrow. Transition here is very wide. So you could just navigate this very rapidly up and down. So that's the key takeaway on Celsius. So, all right. Okay. Where are we at now? 67, 32, 40. It looks like we're performing a kind of trying to perform a bottoming type structure here. So we'll see how that happens. We'll see if that fails. Again, 67.50 back to the upside is going to be the key level. Let me go here. So here is, this is obviously not live. So DS here at 6,800, negative X, everything overhead. That's going to be your first headwind. And then we have 67.70 here, and then I have 67.50 here. So we're probably going to open somewhere around in here. So if you take back 67.50, I'd be looking for 67.75, and then the bottom of DS at 6,800. All right. Okay. Thanks everybody for joining us. Sorry about those pauses. I had to answer those calls. Appreciate it. Again, everybody taking the time to join us all week. We've had great interaction. Like and subscribe on X and YouTube. We'll try to post some content today if our G team is available. And then I may pop back in here after the open with a live look at the overall market as well as the charts once we get open and settled. Okay. All right. Thanks everybody for joining us. Again, make it a great day. Manage risk as always and stay safe. We'll see you later.